Hello and welcome along to the PPW pod, bringing you news, views and interviews from the real estate marketplaces and prop tech industry every week. You can find us pretty much anywhere you get your podcasts. And when you do find us, make sure to do all those things that podcasters always say. Any likes, subscribes, comments or reviews are very much appreciated. My name's Edmund Keith. I'm the editor of onlinemarketplaces.com. Joining me for this one today are Harvey Hancock, one of Online Marketplaces writers. How you doing, Harvey?
Very good, thank you, Ed. Great to be back.
And our boss and Online Marketplaces chairman, Simon Baker. How you doing?
I'm very well. Stop calling me your boss, but yes, I'm very well.
Well, we'll see. Today, we say news, views and interviews. Today's episode is a bit of a newsy one. We are going to discuss 3 different news items with kind of broader topics that we've covered over the last 10 days or so. The first one, we've kind of gone by how much money is involved, I guess. The first one concerns iBuying and OpenDoor. Harvey, do you want to intro?
Yeah, sure. Thank you, Ed. So OpenDoor 101, for anyone who isn't aware, biggest iBuyer in the USA. I'll give you a brief rundown of the business model. If you're a seller, OpenDoor will buy your house from you in a matter of days. Almost no questions asked, no involvement with agents. Very nice and easy. If you're a buyer, you go to a listing on OpenDoor, first come, first serve, no gazumping, no bidding wars. If you make an offer and you sign that contract, the house is yours. So a nice little model. The problem is that OpenDoor has lost over $2.5 billion since 2020, right? Really tough market conditions. And while portals like Zillow and Redfin have already given up on iBuying, OpenDoor has remained stubborn and stayed in the game, which is good news, finally, for them. They have successfully managed to reduce their losses from 2022 from 1.4 billion to just a sliver of that, just the 275 million lost in 2023. In other words, they lost 80% less money last year than they did the year before. Interestingly, they've somehow managed to achieve this with roughly half of the revenue. So there seems to be some structural, some operational efficiency starting to emerge from the business. Long story short, the biggest iBuyer in the US is selling fewer properties, but appears to be getting its business in order, and not a moment too soon. And Ed, it's back to you.
Yeah, I think I'm just going to let you tee off, Simon. iBuying, for me, like, as somebody who's never run a business, who doesn't have a mind for business, those numbers just seem absolutely insane to me. I don't know how you can lose, 1.4 billion or whatever it was in 2022 and still be a going concern. Is this just investors refusing to quit, throwing good money after bad, and they should have thrown in the towel a while ago, right?
Well, I think the Zillow lesson is that you give it a crack and you see if you can make the iBuying model work. And if you do, fantastic, you keep running the model. But if it doesn't, get out of it. And they retreated quite quickly when they worked out they can't make a margin. And I think it comes back to just common sense at the end of the day. You have to buy the house. Now, you're not going to buy the house at dramatically below market price. You're going to have to offer around market, because for most people, this is their biggest asset. And unless they're a distressed seller, why would they sell their property at a 5 or 10% discount to market? Okay, so that's the first sort of, I think, flaw in the model. The second is you have holding costs, and clearly there's been inflation in the US. Interest rates have gone up. That's cost you a lot more money than when it was 1 or 2% cost of capital, and now it's 5 or 6, 7%, whatever the number is. So that means the carrying costs become a bit of a problem, especially if it takes 6 to 9 months to sell the property. And I'm not sure what the average holding time is for these properties. And then you've got all the other costs, the costs of maintenance. So while you're holding the property, what do you do with it? Do you rent it out? Do you maintain it? You got to cut the grass. Literally basic things like that, because you want to sell it again. Secondly, you've got any renovations that need to be done to fix the property up. That costs money. And you've got the selling costs, which in the US, of course, is around 6%. Now, clearly with OpenDoor, they can keep half of that. as the acting as the seller's agent, but they're going to have to share 3% with the buyer's agent. So when you start to layer on all these costs, it's very hard to see how you can make money. And I remember at a probably Porterwatch conference, maybe, I don't know, 2018, 2019, when we were looking at the iBuying model, and it was the biggest things in sliced bread, especially with Zillow. Their share price had exploded on the back of this. But you looked at the unit economics, and the unit economics where they were losing money on every single property. And what we're seeing is that the same is happening with OpenDoor. And yes, they've narrowed their losses, but it seems to me on a quarterly basis, they've dramatically reduced the number of homes they've bought. They've got less houses they're selling, and so on. So yes, of course, your costs are going to reduce, and you can try to narrow that loss. But one way to narrow your loss completely is to get out of the business, right? Because I've got a feeling that it's going to be very hard to operate profitably long term. Now, what's interesting is you look at trailing 12 months, they've got about 8 or 9 billion of revenues coming in, but their market cap is 2 billion, right? So it's a very, the market is just no longer valuing this underlying model. They've said, no, wait a second, the maths just doesn't add up, and what it was promising just hasn't delivered. So I think overall this model has a problem with it, is that if you do end up carrying the stock, you do end up becoming tied to it, that underlying model. It's very hard to make money. Now, what's interesting is companies like Knock have changed the model. They've gone through this whole post-COVID wave of increasing inflation and such, but they changed their model to
Knock was never an iBuyer, was it? Knock was
no, but they were basically offering the loan. They ended up having some of the properties themselves, and so on. And they've changed their model to reflect that the iBuying model just doesn't work. And they've found a way to do the bridging capital for those who are wanting to buy a house today but haven't sold their current property.
Okay, so talking about switching up the model, I think that's something that OpenDoor has tried to do. They're trying to become a marketplace, and I think it's a company that operates in Europe that does iBuying, or did iBuying, Casavo, have essentially changed their model as well. They're now essentially, as I understand it, a brokerage. Spending all of this money just to get to the point where you go, oh, actually, maybe we should be a brokerage, or maybe we should be a marketplace. I'm just interested, how as an investor are you viewing these businesses? Are you saying, okay, fine, we'll give you more money to go and pivot and be a marketplace or be a brokerage? Or, surely at some point they say, no, we're just going to cut our losses, and, you can become a WeWork.
Yeah, I first of all, as an investor, there's no way I'd invest in the iBuying model. I never thought it had any merit about it. What I think does have a lot of merit is this sort of tech-enabled brokerages, which are fundamentally real estate agents or brokers, but they are heavy users of technology to really reduce costs and run at a higher operating margin. And they get smarter about how they drive leads, and thus they can do higher volumes on a per salesperson basis. That's where I think the opportunity lies in all of this, not in the iBuyer model where you're buying and holding, then selling. It just doesn't make sense. So I'm not surprised that Casavo has pivoted, as it's what startups do, right? They go out, raise a chunk of money on a promise of what they're trying to do is going to change the way the world works. They learn a lot in that process, and then eventually, through a combination of reality and shareholder pressure and running out of money, they pivot. They pivot into what makes most sense, and they'll leverage whatever technology they've built to then chase after the easier pools of money to get without the big balance sheet type issues that come along with holding property.
Okay, another another question for another time is, at what point can you still call companies like this a startup? But we'll leave that.
Could I jump in for a moment?
Yeah, go.
Ed, and ask Simon a question. These iBuyers came along at one of the worst economic points in like financial history. We've been having wars and all kinds of global macroeconomics, blah, blah, blah. Let's say the year is 2030. There's no wars. All industries and all economies worldwide are starting to grow. Is there money in iBuying in that environment instead, where that you've got a fast-paced market, a lot of people with a lot of wealth moving, or is it just destined for the graveyard, no matter what economic climate you're working in?
I think it's destined for the graveyard, no matter what market. So you think there's sort of three sorts of markets. One is where there's rapid growth in demand. So I've got a house to sell. In Australia, you might put it up for auction. You get 30 bids, and you receive a price higher than you had expected. Same in other markets. If that's the case, and you price your house at, I don't know, £500,000, if it's well priced, you're going to sell it because it's priced at the market because the demand is there. No room for an iBuyer, because an iBuyer is working on the fact that they can buy marginally below that price. And then the question is, if I want to do that, why would I sell lower than the market? It makes no sense. And then the question is, can they hold it long enough that the market moves far enough that they can then make a profit? But you've still got renovation, you've got maintenance, you've got all these other costs. You're not going to be running at a 40% EBITDA margin. So you might make some money, but you've got to operate at such massive scale, and you're holding risk because, as we've seen, economic cycles can change quite quickly. So clearly in a down market, it sucks, right? Because there's just less demand for properties, so the prices are falling. You don't want to be near that market. Once again, unless you've got a very long hold type view. And then the other ones where it's sort of a flat market. Well, if it's a flat market, what you're doing is a market maker, right? But you've got to be very clear on the markets that you're going after. You've got to be able to use your AVM models to absolutely price. You're going to offer, Harvey, I'm going to offer you 10% less if you need the cash today. But that's a hard world to operate in. So no, I think it was an intellectually interesting concept that looked fantastically good on an Excel spreadsheet.
Okay.
And then hit reality.
All right, moving on to another story in which we're going to use the word billions, which we've seen in the industry over the last few days. Idealista, which operates the market-leading real estate portal here in Spain, but also in Portugal and arguably in Italy as well, is reportedly up for sale less than 4 years after its last sale. Now, this is all at the moment rumors. This is El País, a newspaper here in Spain, have reported it. They've published two stories with that classic "people with knowledge of the situation" quotes. Apparently, Morgan Stanley have been engaged to find a buyer. Apparently, other private equity companies that aren't the current owner, EQT, are involved potentially as buyers. And apparently, the price that's been set is 2.5 billion. Now, first question here: Idealista was sold for 1.3 billion back in 2020. It seems that the people involved have doubled their money in 4 years. Does anybody know if Idealista has doubled its revenue or doubled its number of markets or doubled anything in that time?
Yep. I think the way to think about it is probably slightly different. First of all, if you're a PE firm, you're not in this for a very long term. You're in it to ensure that you make money, a good return on your investors' funds at the end of the day. So clearly, if it's in the paper that it's being reported about being for sale for 2.5, either it's speculation or someone's just floating a balloon to see what the response is going to be, but it's also setting a price or a price expectation. So if you're not interested in spending around 2.5 billion to acquire, the company generating, 220 odd million in revenues, with what I think about 80 odd million in EBITDA, then don't engage in the conversation. So it's almost like a filter that's out there. then I think the way you have to view it is, being a market leader, how are other market leaders being valued in the market? So if we look at take European type players, Rightmove, CoStar, not CoStar, sorry, Hemnet, Scout24, things that you can sort of get access to quite easily because they're listed. Rightmove, Scout24 are sort of at that range, around 11 times revenue.
So we're saying it's being priced just basically on its competitors, not anything to do with the previous sale price only 4 years ago.
No, you wouldn't do it on the previous sales price. I mean, clearly, if you do the way you do this is you look at the current business, you look at what it's worth on a couple of metrics. What's it worth on a comparative basis with like-for-like comparison out there, on both a revenue multiple and an EBITDA multiple. And then you would also do a forward projection and a discounted cash flow back on with some reasonable discount rates. And you'd say it's worth 2.5. Then you say, is that materially higher than what I paid for it? And if the answer is yes, then let's see if we can cash out, and we'll sell it to whoever it may be. Now the question is, who might it be, and is it a reasonable price? And I think looking at those sort of comparisons with other European players, so Idealista is, we did some quick calcs before, 11 times revenue and about 30 odd times EBITDA, which is sort of feels high. But then you start to compare, Rightmove's at 12 times revenues and 16 times EBITDA, but that's because Rightmove's got this massive EBITDA anyway. Scout24 is around 10 times revenues, 20 times EBITDA. So that sort of feels, okay, doable, right? 30 times EBITDA feels a bit high, so maybe the margins aren't as good in the Idealista business. But then you start looking at some others out there, and everyone loves to hold up REA as the one, right? Because it's, as we spoke in a previous podcast about vendor paid advertising, please don't use REA as a comparable because it's rubbish, right? But they're trading at 20 times revenue and nearly 50 times EBITDA. Now, that's just not long-term sustainable because by definition, it takes you 50 years to get your money back. Okay, no one's going to. That's not long term. And CoStar, because that's the flavor of the month at the moment that we're looking at with all what they're doing, is they're trading about 13 times.
Yeah, I remember. So we had Harvey and I had a conversation when we knew that CoStar was going to come to Property Portal Watch here in Madrid back in October. We had a conversation about, well, who do we think they're buying? And I think Idealista was top of the list, right, Harvey?
It was easily top 3.
Yeah,
and something tells me that they're putting this number out there just in case Florence wants to maybe have a bit of a sniff at a market leader. Be very interesting to see if they are interested in engaging in conversations at the very least.
Yeah, what's also interesting is their European headquarters in Madrid for CoStar.
Yeah.
So I think when you look at this, that who would buy it, and I think it fits into so clearly three categories. One is you list it on a stock exchange, but if you're a PE firm, a sale is much easier than going through a listing process because that is
I think a few years ago they were going to list it and then ended up not listing it, basically because they said the macro conditions in Spain were like really against doing that. So I'd be surprised if they do it.
More challenging. So then you go to, okay, I can either sell it to another PE firm because they tend to, it was sold, was it by Apex, wasn't it, to EQT? Yeah. And then so they sometimes these things tend to go around the PE firms and they're each getting in at the next level and then, with believing that they can help drive it further.
It seems like, I'm going to interrupt there. It seems a little bit like a pyramid scheme. All these like private equity firms just like buying these companies at different stages from each other. As a complete non-specialist in this, what are these private equity firms actually bringing to the party other than money?
Well, they bring quite a things. One is their networks and the access to other businesses they own and helping putting 1 + 1 together. They bring cash into the business to do more market consolidation to drive growth of these businesses because they've got to get an outcome. in this. They'll fund movement into other markets. So you've seen, Idealista has had really good growth in other markets, and has to be funded along the way. Having a private equity owner also, they've got a medium term view, right? So if we have to spend a bit in the next 2 years to get a really good acceleration of growth, so that they do bring quite a lot to the party. And also from someone running the business, it's easy. You've got one owner that you work with, right? Rather than having a listed company. But I think the other group of buyers are, is it the REAs of the world? Does Rightmove go, well, wait a second, we're under attack, maybe we do something here? And we use our listed company stock to buy, which could be interesting because they're trading at 12 times revenue. This is 11 times revenue. It might make sense. Or is it CoStar? That's an interesting one, which we should chat about.
Yeah, I mean,
maybe another day.
I think all three of us want CoStar to buy Idealista rather than some private equity firm, right? I mean, as people who cover the news, that's what we want, right?
Yeah, I'm not. I don't know who I don't particularly care who buys it. To be honest, what I do think though is that it would be an interesting challenge for CoStar, because they've made that big leap across the Atlantic, getting into buying on the market. Still number 3. It's not like you buy it and suddenly you're number 2 challenging number 1. There's a long way to go and a lot of marketing to go. And I don't think it's going to be anywhere as easy as they say. And we've done a podcast on that already. For those who are listening, you can go back and hear that one. And I think if I was in CoStar's shoes, I'd be looking far more eagerly at Zoopla, because I take Zoopla and on the market, put them together. I've now got a stronger market position in the UK and a much better way to take on Rightmove. Buying, I think, Idealista, where you're buying one company but 3 markets in a fundamental language is not your native language, based on hard-won experience from me, is intellectually sounds like a slam dunk, but is in reality incredibly hard to pull off. And the everything from culture to language to the local regulations on employing people in Spain is so different to waking up every day in the US, where it's at will employment. In Spain, if you want to move people on from a business, it is a long, expensive process. So I just think that if I was CoStar thinking about this, I'd be going, Zoopla's a better target, because if I can do that, I've already got a presence in the UK. I've already got myself, I've already laid out very loudly my mission of taking on Rightmove and changing the way that the industry works. So the better way to do that is to buy Zoopla, put the two together, extract the value, and then then you as on the market don't have to fight 2 people. You've got to fight 1.
Okay, well, Harvey and I have got our fingers crossed for CoStar on that one. We'll move on to our third story this week. Harvey, why don't you intro the third story we've been talking about?
Yeah, sure. We're back in America now, and we're going to talk about Zillow, who've released their Q4 results. Let me just go to my notes here. 475 million revenue in Q4, which is a solid contribution to overall revenues for the year of 2 billion. Losses for the year widened to 160 million. And something that I did want to bring up was cash reserves. Cash reserves at Zillow are 3 times less than CoStar Group. So the company does have much less buying power than Homes.com, if that's a conversation we want to dig into briefly. Even though the company lost more money than the previous year, Zillow's performance was better than expected, basically because of bad market conditions, continuing bad market conditions in the US. How do they manage to beat the market? It's because they're the biggest brand, right? They attract eyeballs. Everyone knows who they are. If anyone is a resilient market leader in global marketplace industry, it's Zillow. 2.2 billion website visits in Q4. That equates to 730 million views a month, or 24 million views a day. In light of this, the company will target aggressive expansion of its enhanced market coverage, whereby Zillow joins up with an exclusive list of agents in a particular region and commission shares all sales made through its platform. That's their plan for the rest of the year, and hopefully it will mean smaller losses and more revenues. And Ed, that's back to you.
Yeah, so US real estate companies in general are very keen on this phrase, we beat the market. But you don't hear it so much in the financial presentations in other markets. Does it mean much, Simon? We beat the market? I mean, at the end of the day, do the shareholders really care? They just care if you made money, surely.
Well, no, the shareholders do care. And sort of having a look, they've had a bit of, I think they've got a bit of a spike on the news. And if you think about a shareholder, right, you buy your share at, I don't know, $50. What's currently $55 Zillow, right? You buy your share at $50. You know the results are coming up next week. If they beat the expectation of the market, then the share price will jump a bit. Okay, and then you sell at 55. You made a 10% return in a 1 month or a short period of time. So yeah, you as a shareholder actually care about that because they're not paying dividends, right? So all you care about is the movement of the share price. So therefore, beating the market is actually quite important from that perspective. The question is, what was what drove the expectation of the market? Was it massive enthusiasm and great, or was it just like, oh my God, well, here we are 10 years into this project and they're still basically breaking even? Okay.
Yeah.
And so then you're beating low expectations. Having been a chairman, having run a listed company as a CEO, and also having been chairman of multiple listed companies, life is always much happier when you beat the market, beat the expectations of the market, because then you'll get what happens is it becomes a cycle, right? They get a positive view of the stock. People start to buy into it. They follow your story more aggressively. If you fail to meet the market expectations, then you get hammered. Right, it's a sort of
this is something I want to talk about quickly, actually, because back in, I think it was 2021, Rich Barton, the CEO of Zillow, very confidently said, we will be doing 5 billion in revenue and 45% EBITDA margins by 2025. Now, there's no way they're going to make that. And he very confidently said it in 2021. It seems like everyone has forgotten. It seems like, well, he can say that and he's going to get away with it. You have been in that position where your comments actually affect the market. Is he going to get away with saying that?
Yes. Yeah, because the US market in particular is a very short memory. I mean, if you go back, they were saying back in 2018 or something that the iBuyer model is the best thing since sliced bread, right? It's like the most amazing thing that they've ever done. And I think in those days, the share price probably got up to $160. Okay, if I remember correctly, I might quickly
it was more, it's 200.
Yeah, and now it's trading at 50. So between February the 1st, 21, and you're out there saying we're going to be amazing and wonderful, we're going to do 5 million by 2025 and do a 45% EBITDA margin, then sort of reality sets in, right? So, and you can see if you look at their share price, it's gone from that sort of nearly 200 level right down to just tracking around the 30s, 40s, and 50s over the last, two and a half through 2, probably about 2 years. And I think the market is sort of going, yeah. And you look at the results, right? They've basically done a couple of billion in revenues. Congratulations, well done. You're still a long way off getting to the 5 billion in revenues by 2025, and you've only got, 2 years to do that. So I can pretty much put a line through that one. And your EBITDA, this is the thing that sort of is a bit of a worry, is that your EBITDA is all of about 78 million on 2 billion. Okay. And if you look over the history of the business, it's never really produced a great return.
Yeah, I think that's probably why that they're trying to really lean into these enhanced markets where they only do commission share.
Yeah,
You're
it's a
right.
transaction model.
Yeah, it's interesting. I asked, so my wife is American, and she asked me the other day, how much money does Zillow make? And I said, well, guess. And she said, oh, I'm sure they make loads and loads of money because everybody's heard of Zillow. And she was very, very surprised to find out that it makes a loss.
Yeah, it's for all intents and purposes a break-even business. Okay, and that's because if you've got to look at the core of it all, when you peel everything back, right? There's a lot of advertising-driven revenue. Okay, but that's driven in a MLS environment. So agents aren't paying to put their listings on the site. Agents are paying to brand themselves on the site and hopefully get more leads. Now, the problem is that when you're paying to brand yourself, you get higher levels of churn of agents. So the agents are coming and going and coming and going and coming and going. When agents are coming and going, you need to have a sales force to hopefully stop me from going, and then to come and knock on my door again 6 months later saying, hey, you used to advertise on us. So you have this process of where you need to have high levels of costs. And you can see this throughout these numbers and honestly over many years. If you go back over, whatever it's been, 10 years of being listed, probably longer now, it just is a very hard model to make a seriously good cash return overall. But they've still got a business that has a market cap of $12 billion. Okay, so there's 12 billion of value tied up in there. Is that value being truly realized at the moment? The answer is probably no. That's why 12 billion to the 2 billion of revenue. So it's only trading at 6 times revenue, and forget the EBITDA multiple because it's close to infinite. And that's why the valuations of these businesses in the US are fundamentally much lower on a pound for pound basis versus Europe and Australia and other markets. It's because they're just not generating the free cash flow. And you can keep pivoting your model from an advertising model. If you think about it, they've gone advertising model, pivot to an iBuyer model, pivot back to an advertising model, or they sort of kept the advertising model going. Now they're pivoting to a transaction model where they're sharing in the transaction revenues. Okay, that'll should release more value, but can they do that at an EBITDA margin like a Rightmove? Forget it. No one else is going to do that at 70-odd%. Can they do it more like an REA, which is sort of like at the 40-50% for their overall business? Very hard, super hard, right? So maybe they're going to be one of these things that might get to a 10-20% EBITDA margin. But that's a lot of hard work to get there. And to date, they've never got that far. So I think, overall, it's a hard model. I just think the US is a hard market to really make good returns. And if you could go back in time and you could start one of 3 businesses, the Rightmove type business, the REA type business, or the Zillow type business, if you just measured it on eyeballs and traffic, you do Zillow every day of the week. If you do it in terms of, can I really become a market leader and just extract a high margin, like super high margin, then you do Rightmove. But if you want to do a really good blend of the both, then I think REA is the one that you go after, because you have the capacity to move your revenues up because it's a vendor-paid advertising market. You can run it very profitably, and then you can leverage all of that and move into other markets, which neither Zillow nor Rightmove have done.
Could I jump in with a question there, Simon? Which
Sure.
is that we had a conversation in a previous pod about whether CoStar will overtake Zillow in the next 10 years, for example. Given all the information that you've just shared there and how it's not a massively profitable business, yada, 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 I won't rehash everything you just said. Is Zillow the most at risk of all the market leaders worldwide to be overtaken because it's not a huge money spinning behemoth?
Well, it depends how you define leadership. So if we define leadership as visits and eyeballs, then the challenge that homes.com have as being part of CoStar is that you have to get your average US punter to stop thinking about Zillow as the first choice, to not visit realtor.com, but to visit homes.com. And I think that's the real challenge. Now, when there's no brand, if you go back a bit of history, there was fundamentally Home Store, which became realtor.com. They didn't spend massive amounts of money on marketing. So there was an opportunity for the Zillow to come in and create a presence in people's mind. And they did it through their Zestimate model. So realtor.com basically been owned by the industry, the NAR, in conjunction with, it was a listed company then, before it got bought by News. They didn't want to release a model that allows someone to find out the value of their house, because that's the role of the real estate agent. So Zillow could come in and do something that didn't exist before. And in that process, they established themselves as independent from the industry, as the place to go and look. And they did a great job at getting all the listings. They mopped up Trulia, which was very good on a lot of housing data, suburb-based data, etc. And we're going to talk in another podcast in the future with Brian Barrero from 1000 Watt Consulting about the US market. So stay tuned for that one. And so those sort of positions in people's minds have already been taken. So Homes has to spend a lot of money to dislodge an existing brand. That is the real challenge, right? If you're a Coke drinker, how much money has Pepsi got to spend to get you to drink Pepsi? The answer is a hell of a lot. And it does. And think of all the money spent over all the years by Pepsi and Coke, and it's still Coke, right? The absolute value in being the incumbent is enormous in these markets. So I think the Homes.com has got a real challenge. They might be able to spend a fair chunk of money, buy a whole bunch of short-term Google-type traffic to spike the numbers, but will they have long-term loyalty to the brand? I don't think 20 Super Bowl ads is going to make that difference.
All right, gents, we'll leave it there. Harvey, Simon, thanks for your time, and until next time.
Thanks, gents.
Pleasure as always.